Let us see the next question. On 1st of August 2023, an investor has a portfolio consisting of the 5 securities as shown below. So information is given, say, about an investor holding 5 equity shares, that is 5 securities, and sets list have been provided to us. Security A to security E, number of shares that the investor is holding, its market price, and its respective beta is given to us. Cost of capital of the investor is 20% per annum compounded. The current NIFTY value is 19,500. NIFTY futures are available with expiry for 3 months, that is October 2023, and 4 months, that is November 2023. So we have been provided with the information that say that today's date is say 1st of August. So basically we have been provided with the information that August, September and October, 3 months expiry information is given, and November, that is 4 months expiry information is given to us, and are currently quoted at 19,700 and 19,900 respectively. So basically the futures value have been provided to us for both the dates, that is for the October and November. Each NIFTY futures can be traded in units of 50 only, that is the lot size is given. You are required to calculate the first is beta of his portfolio. We know that the beta is computed as simple weighted average, that is required to be found in the first question. Theoretical value of the futures contract for the contracts expiring in October and November. E raised to 0.05 value is given. E raised to 0.06 value is given. Now, the number of the contracts of the NIFTY the investor needs to sell. So very good answer that they have provided along with the question. Let's say for the purpose of hedging, you have to enter into the short position because right now you have long position. To get full hedge until November for his portfolio. Dear students, the term full hedge stands for, say you want to have the beta 0. Fourth, the number of the futures contract the investor should trade if it desires to reduce the beta of the portfolio to 0.25. That is a question. I request all of you to go through the question, please. Dear students, in the first part of the question, we have to compute beta of the portfolio, that is simple weighted average. We will consider that say what is the amount that we have invested in individual security. We'll make the computation of the proportion in which the investment is made. That proportion into beta, that is the way weighted average beta of the portfolio can be calculated. I request all of you to write down answer. Working note number 1. Calculation of beta of portfolio. In that, column number 1 is name of the security in which investment is made, amount, its weight or proportion will be calculated, it will be multiplied with the respective beta and weight into beta. That is the way the beta of the portfolio will be calculated. So over here, say investment is made in security A. We have made investment in 450 shares and market price of the share is 60. B security, investment is made in 850 shares and market price of the share is 320. And so on, we are required to make further calculation. Investment is made in security C. Its market price is given as rupees 640 and number of shares are given as 200. Security D, market price is 130 and number of shares are given as 500. Next is security E. In that, market price is 480 and number of shares are given as 600. This is the way the amount of the investment will be calculated. So please use your calculator. 450 into 16, that comes to 27,000. 850 into 320, that comes to 2,72,000. Next it is 640 into 200, that comes to 1,28,000. Then 130 into 500, that comes to 65,000. 480 into 600, that comes to 2,88,000. So basically what will happen, 27,000 plus 2,72,000 plus 128 plus 65 and 288. So the total value of the portfolio is 7,80,000. Okay. After making calculation of the value of the portfolio, we'll compute the proportion in which the investment is made. So 27,000 divided by 7,80,000. So 0.0346. 2,72,000 divided by 7,80,000. 0.3487. 1,28,000 divided by 7,80,000. So 0.1641. 65,000 divided by 7,80,000. 0.0833. And for the last one, we'll take the balancing figure. 0.0346 plus 0.3487. 1641, 833. Total of all of them would be subtracted from 1. That is 0.3693. So we can compute this also like this: 2,88,000 divided by 7,80,000. So it is 3692. It is only because of some approximation that we have done earlier. So better to always check that value. Beta is given to us. It is 0.87. It is 1.31. It is 0.94. 0.66. 1.50. So 0.0346 into 0.87. So 0.0301. 3487 into 1.31. 0.4568. 1641 into 0.94. 0.1543. 833 into 0.66. So 0.05. 49. So I'm taking 50 once again. 3693 into 1.5. So 0.5540. So 0.0301 plus 0.4568 plus 0.1543 plus 0.055. So it is 0.6962. That is the way, first of all, we'll make the computation of the beta of the portfolio. Right now the beta of the portfolio is 0.6962. Now I am reading just further information of the question, dear students. The question is providing to us the information that today's date is 1st of August. Information is provided to us that the cost of capital is 20%. information is given that the current Nifty is 19,500. Nifty futures are available with an expiry of 3 months, that is October 2023, and for 4 months, that is for November. It is 19,700 and 19,900 respectively. And so it is August, September, October. October end is given, and of course, so the November end is given. Then we have been provided with the lot size of 50 units. The first question is compute the beta of the portfolio. That is what we have done. The next question is compute the theoretical value of the futures contract for the contracts expiring in October and November. So what should have been the price? That is a question. So I request all of you to write down answer along with me. For second question, as far as the futures value is concerned, it is spot into e raised to rf into t. That is the way we are supposed to compute the futures value. Let us say that for the month of October, it would be calculated like this. Spot value is given to us in the question as rupees 19,500 into e raised to 0.20 raised to 3 divided by 12. So it is 19,500 into e raised to 0.20 into 0.25, that comes to 0.05. Now we can see that the information is provided to us directly. Then what is the E factor? You can see that the E factor is provided to us directly. So 1.05127, that we have to use directly. 1.05127. Into 19,000. So it is 20,499.765. That is very near to 20,500. That is for the month of October. Now for the month of November, we have to be slightly careful, because what will happen, dear students, as far as the November month is concerned, in that e raised to rf into t once again. The term rf is 20%. Time period would be 4 divided by 12. So e raised to 0.20, 4 divided by 12, that is 3. That is e raised to 0.0667. That is what we understand. Now, in order to make this calculation, we have been provided with e raised to 0.06 and 0.07. So that we are required to do interpolation. So e raised to 0.06 value is given to us in the question as 1.06184. And e raised to 0.07, for that it is 1.07251. So basically over here 1.07251 minus 1.06184, that is 0.01067. That is what we understand. Okay, now we are required to do interpolation. So it is 0.0667. So what will happen, dear students? We are required to take the value like this: 1.06184 plus 0.01067 into 2 divided by 3. Will compute the 2/3 value. How that 2/3 value comes? It is 0667. That is the reason it is 2/3 value. So the final answer would be like this: into 2 divided by 3. This answer plus 1.06184. So it is 1.06895. Okay. Afterwards, we are required to compute the future value for the month of November. So for November month, it is spot into e raised to rf into t. Spot value is already given to us 19,500. RF is 0.20 and time period is 4 months. August, September, October, November. So it is 4 divided by 12. So 19,500 into e raised to 0.0667. So it is 1.06895. So 1.06895 into 19,500. So that comes to 20,844.525. This is the way the futures value for the month of November will be calculated. Okay, next. That is what we understand is the answer of the second question that we have done. Third question is number of the contracts NIFTY, that is of the NIFTY, the investor needs to sell, that is a short position. To get full hedge means required beta is 0 until November for his portfolio. Importantly, dear students, for the purpose of doing third part of the question, this value is of no use to us. Why? Because the question is ready-made providing says values to us. That is the reason we are required to take this value, since we are required to do hedging for the month of November. So I request all of you to write down answer along with me. So answer of the third question. Number of contracts to be sold. In that, further I am writing for full hedging comma till November. In that case, dear students, it is value of the portfolio into beta of portfolio minus beta required whole divided by futures index value into lot size. As far as the value of the portfolio is concerned, that we have computed in the first part of the question, it is 7,80,000. This is 19,900. So it is 7,80,000. Futures index value is 19,900. And lot size is given as 50. Beta required is given to us in the question as 0.6962. So over here it is 0.6962 minus 0. This is the way number of contracts to be sold will be calculated. So 0.6962 minus 0. So I am solving that bracket first of all into 7,80,000. That becomes the numerator divided by 19,900 divided by 50. That comes to 0.5457. That is only one contract. So I am writing over here value 7,80,000 into 0.6962 divided by 19,900 into 15, that comes to 9,95,000. So answer is only one contract, because we cannot enter into the fraction number of contracts. That is the reason. Fourth question. In fourth question, the question is providing the information that you are required to compute the number of contracts the investor should trade. Trade means, say, you have to decide whether to take long position or short position. If it desires to reduce beta, when you want to reduce beta and you have the long position in the cash market, you have to enter into the short position. If he desires to reduce the beta of his portfolio to 0.25, that is a question. Dear students, over here the question is not providing, let's say you want to hedge your portfolio for October or for November. So over here on a safer side, I am writing answer by both the methods. Write down answer. Calculation of number of contracts to be sold for October and November for the purpose of reducing beta of portfolio to 0.25. So write down the formula. Value of the portfolio into beta of portfolio minus beta required whole divided by futures index value into lot size. Value of the portfolio is 7,80,000 multiplying with beta of the portfolio is 0.6962, beta required is 0.25 divided by futures index value into lot size is 50. So 0.6962 minus 0.25, so 0.4462 into 7,80,000, that comes to 3,48,036 divided by futures index value into 50. Okay, now what will happen, dear students? There are two futures contract in which we have to enter upon, because the question is not providing exactly for which month you want to do hedging. So it is October and November. So it is 3,48,036. The futures value is given to us 19,700. Into 15, and over there it is 3,48,036 into 19,900, divided by 19,900 into once again 50. So 3,48,036 divided by 19,700, divided by 50. So it is again coming in the fraction. So we'll enter into only one contract. Mostly same would be the answer. 348,036 divided by 19,900 divided by 15. That comes to again one contract. So this is the way we are supposed to do hedging of the portfolio. So let us have a revision of the entire answer. In the first question, we are required to make the computation of the beta of the portfolio. In that case, we are required to compute the amount of the investment that we have made in the individual security. What is the proportion in which the investment is made, multiplying with the respective beta. That is the way the beta of the portfolio will be calculated. That's very simple. In the second part of the question, we are required to compute the future value. For the month of October, it is spot plus interest. No dividend information is given. For the month of October, the answer is quite simple because for 5% directly the E factor is given. For the month of November, say it is raised to like 0.0667. So we are required to do interpolation of 6 and 7, and accordingly we are required to compute the future value for the month of November. In third question, we have to simply calculate the number of contracts to be sold for the purpose of perfect hedging till November. That is value of the portfolio calculated in the first part, beta of the portfolio again found in the first part, beta required is 0 divided by futures index value into lot size. Just be a little bit careful that the answers calculated in second part of the question is not to be used in the third part. In third part of the question, we are required to calculate the answer based on the value which is given to us in the question. In the fourth part, I have done the answer by taking, let's say, the number of contracts to be sold for October as well as November in order to reduce the beta to 0.25. And since the answer is coming in less than 1, that is a fraction, and fraction number of contracts cannot be entered upon, so I've written that the one contract will be entered upon.